Hey everyone, hopefully you're having a good day. My name's Andy, channel's Finding Value. Scrolling through Twitter, I'm going to share some information from Twitter. I like doing this because I see a lot of new things that people are posting. It's basically a wide array of differing opinions on the markets. I'm going to give you my financial opinion on that and basically decode it with what I know in the markets. Obviously, I'm a heavy chart reader. I also look at the fundamentals of companies, supply, demand, imbalances, cost curves of commodities, and I look at other leading indicators. So I try to tie the data with what I know, and I'll give you my opinions on it so you guys can kind of see what I look for in this information. So let's dive in. If you want to follow me, I'm Finding Value Finance at finding_finance. If you want to follow me on here. I'm going to zoom in a little bit so you guys can get a big, I'll zoom one out. There you go. Big picture view of it. This is John. This is Platinum. Very nice entry here is what he's saying. I tend to agree. What I do, and I'll tell you my approach here and strategies to investing. I'm a long-term investor. I identify consolidation periods. So what I'm going to do is I'm going to pull up another chart here on TradingView of Platinum. And I'll kind of describe my approach to investing so you guys can better understand how I approach things. So here's Platinum. I'm going to back out with the big picture view. I'm just going to kind of delete some of this stuff out of here real quick. And what this is, it's a big picture view of Platinum. We've got a bull market here, and then we went into a consolidation period starting here to here. That's the consolidation period inside of this pattern. Patterns are created in consolidation periods. This is an impulse move higher, and this is a consolidation from circle to circle. And then what I am thinking is going to happen is we're going to have a big impulse move higher. Why do I think that? Why would I think that platinum and gold and all these things are going to go into an impulse move higher? It's based off of inflation in the system. Every time we get these impulse moves where I've drawn these lines going up, this was in an expansion phase of real estate. We're going into an expansion phase of real estate, and this was a disinflation period where real estate was in a recovery phase. That's what I tied it to. The moves of this and how I play this is I identify the pattern and I buy and cost average in all in this bottom here in the tip. And then I'm buying again in this tip over here. And then I'm waiting for the big move. It'd be like buying it in this vicinity here and then buying it again here. This pattern's the same pattern as this thing. It's basically a big lead-in for a big run. At least that's my opinion. So what I'm doing is I'm accumulating in these two circles here over time. So I'm not trying to time my purchase necessarily in terms of day-to-day movements. I'm purchasing in the general vicinity of where I think this thing is cheap. And then I'm going to ride this thing higher for the big bull market. I had on some of my positions that I purchased in this general vicinity, I was down for some period of time. This here was the 2020 COVID crash. That crash, people are afraid of. I'm afraid of a crash. I want to not be invested. I want to avoid the crash. Well, what I did is I started to cost average in. I cost average in here. It started going up. It came back down, and I bought a whole bunch in this other circle. I am working. I do have income. I continue to save that income, and then I deploy it where I think is a good entry point. So I bought a bunch at the bottom, and I bought it as it came back up, even all the way up into that vicinity up there. And I just cost averaged in. That's how I reduced my risk of volatility. But notice something. COVID brought this price down here in platinum. It brought it down, but it couldn't hold it down. This recession couldn't hold this price down. The cost curve is at where this line is at, basically. This is below the cost curve. You can buy below the cost curve. You will make money. They're going to cut production. They'll cut that all back, and the price has to go higher at that point. But the market conditions, in my opinion, are ready to go higher. We've broken out of the pattern. That is where you buy it, is on the retest. We are retesting it. So just to let you know, that is my strategy in all of these different types of assets. I'm not playing the day-to-day movements. I'm playing the big moves. I am playing buy it down here, and then sell it all the way at the top and convert it into another metal. Or convert it into a metal somewhere in here if the ratio permits. It all depends on what the ratios are. But I wanted to just go over that and tell you my strategy. Right now, this is a good entry point. Platinum is cheap against all the other metals, and it is right against its retest, and it's squeezing up in this corner here. Looks fantastic to me. Good job, John. Here's Josh Young. Munich restarts oil-fired power as surging gas batters Germany. Munich also pushed back on conversion to move away from coal. Authorities are taking measures to cut natural gas demand. So what they're doing is they're substituting natural gas with oil. Are people realizing this? That we're going to get more oil demand in this world? And it's much deeper than what most people think. There could be reasons that the Strategic Petroleum Reserve is releasing oil. We may be, helping Europe in their problems, trying to reduce the price of oil as they are using alternatives to for natural gas. They're going to start burning more oil to lower the costs over there, but it's only going to be a temporary fix. If they continue to substitute oil for natural gas, and we run out of the Strategic Petroleum Reserve releases, or we stop doing that, we could see a big super spike in oil at some point in the future. Late 2022, early 2023. I'm not going to try to speculate on the exact timing of it, but I think it's coming. And we're seeing substitutions out there. This is Brian. He says, solar received 42 times more subsidies than nuclear per unit of electricity generated. Just a nice, cool little stat there. Scrolling down, it says, saving rate continues to evaporate, now at lowest 5.1% since August 2009. I wanted to make a comment about this, and it pertains to myself as well. So this is the U.S. personal savings rate as a percent of disposable personal income. If you look at some of the other charts that I've posted, we have record amounts of money in checkable deposits. We've got a ton of money already saved. So my question to you is, if you have a record amount of savings, why would you need to save more money? Why is that the case? Isn't it natural, if you went to a savings rate off the scale up here, that this would actually maybe go to the opposite side at some point? Why would we continue to save at 25 or 35% if the person thinks that that's an adequate savings level? I was thinking about this myself. I've saved a ton of money over my life, and I've invested copious amounts of money. I'm getting to a point where I'm about to start spending money and not saving it. My savings rate will dramatically decline at some point when I feel that my savings and investments are at adequate levels that I don't want to save much more money. I'm going to get to an age where it's like, why am I saving this if I already have enough money in investments and my investments are going up? Why would I save more? So maybe perhaps some people are like myself, and the savings rates, especially if you're a baby boomer, why would they save? They're going to start to go into spending mode. And I would assume that millennials would as well. So I'm curious to see how the demographics would also impact this type of savings rate. And I can see in the mid-2000s here, the last commodity bull market, that the savings rate actually did decline over that time frame. We had very low checkable deposits and savings in here. We had 80 billion in 2008. Right now, we have 4.5 trillion. Huge disparity there. So is the savings rate a function of what's in your savings account? It isn't, but it could be at this moment because we have so much in the checking, the deposits in the banks are so large right now. Here's NewScale Power. This was one of the companies I talked about on our website. We were buying it at the lows, as low as we could possibly get it. It was low $9 that we were getting it at. It says on Friday, July 29th, the U.S. NRC voted unanimously to approve the design certification of the NewScale SMR design. NewScale is the only SMR vendor to submit an application for design approval by the NRC, and the only SMR design approved by the NRC. So that's great. That is great. It says the affirmation of NewScale's design and strong safety case could not have come at a more crucial time when around the world people are struggling from the compounding crisis of volatile energy prices and climate change-driven extreme weather events. We are pleased with this continued recognition of our technology inherent safety design and our potential as a timely carbon-free energy solution to meet our global community needs. That's awesome. That's awesome. Go NewScale. I am a shareholder in NewScale, and so are, I think, a lot of the members on the website that decided to invest in it. More cost inflation, this time from Kazatomprom. And I was talking about miners and the costs of energy inputs and inflation. It says all-in costs up 34% year over year. Wow, that's insane. That is the costs for Kazatomprom increase. It says this is a problem. And I do agree with this. It's not financial related. It says 43% of boys are raised by single mothers. 78% of teachers are female. So almost 50% of boys have 100% feminine influence while at home and an 0.8 chance of 100% influence at school. Toxic masculinity isn't the problem. Lack of masculinity is. I think that's a pretty good quote. U.S. housing. I wanted to share this as well. It says the 2-month change in median price of new single-family home has cratered by 11.9%. Now, I wanted to extract a couple of things here. It's the median price, the middle price, and it's the new U.S. single-family home. So I don't know if that's a good thing or a bad thing, because the new single-family homes went down in price, and I'm not sure if that's a good or a bad thing. If it's down and it's more affordable, I think that's a good thing, because they want to sell more new homes. And remember, that's new homes, and it's the median price. So I'm not sure how to take this because, some people are saying it's cratering. It's cratering. Well, I mean, we were talking about new single-family homes and about the median price. I don't know. We'll see. It says rents. So you think we've got like this housing bubble that everyone's talking about. But look at rents. Rents are 36% of the consumer price index. Good luck seeing a drop in inflation in the August report. It says U.S. rents hit a record national. U.S. rents hit a record national average in July, per rent.com. This is one. It says the last 4 times the spread between new orders and inventories in the ISM Manufacturing Index was this negative. The U.S. was already in a recession. The 2001, 90 to 91, and 81 to 82 recessions never had readings this low. So this is basically the delta between new orders and inventories. What it's saying is inventories are building at a faster pace than new orders are coming in. And when we hit these levels, that we could potentially be in a recession. Now, the one thing I'll say that's different about this time, and I know those words are dangerous, I understand. I'm not saying this time is different, but I'm saying there is a difference. We pumped this system full of cash in 2020. What that did is it created a whole bunch of orders and created the imbalance between new orders and inventories to exist. Now those inventories are being restocked, and that cash that came into the system doesn't exist anymore. So I would suspect that this would swing to the other side, recession or not. So we had this big liquidity bump in the beginning of it, and things are slowing down a little bit. So, I don't know if this is from a form of weakness, because recessions are usually a form of weakness. They are usually a decline in the housing market, housing starts. That's usually what it's from. But we're not having that huge decline yet. We've declined some, but it's not falling off the edge of the cliff, at least not with the current data that we have. We'll see what this month brings. And it could just be a normalization of everything in the system after that big stimulus. U.S. shale producers expected to follow big oil and posting explosive Q2 profits this week. And this is the profits here, the free cash inflow, massive here in 2021 and 2022. Absolutely awesome. And a lot of hedges will be rolling off too. So this will continue to go up as hedges roll off for a lot of companies. So good work there. They're free cash flow monsters at this point. So here's another thing I wanted to touch on. This is housing prices in the 1970s. This is inflation in the blue line, housing prices in the gold line. Now, the inflation isn't tied necessarily to the house price. What it's tied to is the volume of new home loans. House prices can continue to go higher, but your volume of your new home loans falls off. So we went into this here is a recession for housing. It came on up. The inflation goes past it, but it started here. It still went up, home prices, even though we were in a bubble of housing. Inventories increased. We went into a bubble, but the home prices still continue to go up. And in the 1970 to 80 transition, late 70s to 1980s, we did not have home prices fall that much. So we also had prices come back in 69 to 71. That was also a small decline. These aren't, falling off the earth. And then this decline here is inflation is offset behind it with the decline in home prices. So the volume of housing starts is what drives inflation, and home prices also they basically move up quite steadily. So it's the inflation is tied to the volume of loans in the system. I just wanted to touch on that. This looks like oil has put in a capitulation bottom versus U.S. equities back in March of 2020. What he's got here is he's got the oil priced in Dow Jones Industrial Average. It's a ratio. This is the ratio as it's falling down. That is it's an environment where money, it's a recovery phase in real estate. This is a recovery phase in real estate. We've got low inflation, low interest rates. That is not good for oil and commodities. But the Dow Jones outperforms oil in this time frame. When oil outperforms the Dow Jones, that is your inflationary period. That is when you get those loans in the system from real estate. So those loans, the volume of loans come in, you get high inflation, just like we were talking about last one, and then all of these things start to fall into place. Silver's usually lagged a little bit, but the ratio starts to move higher. We've moved higher in the ratio. We've broken out of the long-term downtrend line. This trend line has a couple of hits here, a bunch of hits all through here, a couple of hits through here, and then some hits through here. We've broken up to the upside. We're going to probably do a return move, and then we go rocket time. We've broken also out of this declining wake-up line. So we've broken out of a couple of different resistance lines moving higher. So oil is starting to outperform the Dow Jones Industrial Average. We could see the Dow Jones pull back the same time that oil goes up. So we could see a drastic change, much like the 1970s movement over here. And we could go far, far higher, back to levels much higher than where we were in the past few years. So cool looking chart. I also think silver is going to go higher to a new level. And I think it will follow the oil price higher and the outperformance of oil to the Dow Jones Industrial Average. This is another company that we talk about on the website. Good report on NMM by Henrik Alex, a noted shipping bear. Very interesting to see him bullish on NMM. I agree with his conservative notes, and even he sees potential for 2x or better here. This is Mark Emerson, Stockaholics. I've had him on the channel before. 5-year-old Afromax price continuing to go higher for dry bulk shipping. Looking here, this is gold. I'm just going to go straight into it, the chart. U.S. 30-year yield divided by the U.S. 10-year yield. If you notice, every time we see a large move higher in gold, the 30 to 10-year ratio goes higher. What this is we're looking at market conditions, and when those market conditions are ripe, we see gold, silver, and all these other precious metals go higher. We saw a large move higher here from 2018 all the way till the top. We had a decline in this environment, and we've broken to the upside. Very clear breakout of the 30-year yield divided by the 10-year yield. Gold went up 75% when this came up, 150% here, and another 50% here. It looks like this is breaking to the upside where we could see a move higher in gold. So gold and perhaps the gold mining equities might be a good spot to look at before the move happens. And I've talked about this on the website, the Platinum membership question and answer session yesterday. I was talking about a lot of the opportunities that I see in the precious metals, royalty companies, and all these different companies. And you can sign up if you're interested in that. You can see the video that I videotaped. Gold and silver miners are once again historically cheap. Notice I'm specifically sharing stuff that I think are good opportunities on this Twitter. So this is the gold and silver miners versus US equities, another ratio. That's where you find and derive value. Bottom here are these circles here, historically cheap miners versus the S&P 500. This is really cheap down here, guys, and this is a shoulder, head, shoulder forming. So what I'm doing is I am accumulating specific companies at this bottom here. You have to do opposite of everyone else if you want to make large amounts of money. You have to be early, and you have to cost average in and hold on. There's going to be volatility. It's going to feel like you're getting kicked in the nuts every once in a while. I don't disagree with that. I'm used to it. What, getting kicked in the nuts? Okay, maybe not that. But I'm used to getting the volatility, and I just continue to cost average in. I'm about accumulating at areas that are favorable. This here is a good, solid support level in this region. I'm going to continue to hit it up. I don't care. I'm going to hit it up because the returns here, the risk reward is massive. It's a large asymmetric bet. I think that the S&P 500 will go down. I think gold will go higher. Notice how we're stacking all of this information on top of each other. This information is stacked against the 30 to 10-year yield. The 30 to 10-year yield saying buy gold and gold's going higher. This is saying that we are at a historical low of gold and silver miners versus the US equities. And that the housing market is in an expansionary phase. It's usually, we've got inflation. We're seeing the inflation in the consumer price index. All of this ties together. This is just delayed a little bit behind it. The money is slow to rotate. But I'm gonna continue to accumulate my favorite gold and silver mining companies. This was released. Things are slowing down, but the trend is still higher of the week ending in July 23rd. Listing prices are up 16.6 year over year. Remember, we use year over year as seasonality needs to be removed. So this is what I shared from Realtor.com. This is the weekly update trends report. The week ending July 23rd, which is the most recent data we have, the median listing price was up 16.6. New listings were down a little bit. Active listings are up 30%, so it's up a teeny bit from the week before, and the time on the market is 0 days faster. So we are slowing down a little bit in time on the market. Inventory is coming online, the active listings. But we're still moving up in terms of prices on a year-over-year basis. That's the data that we have. A couple of things I wanted to share, and this is big if you're an investor. Big money is not in the buying or selling, but in the waiting. You have to be able to wait and be very patient. That's where the big money is, guys. Here is 90% of all millionaires become so through owning real estate. More money has been made in real estate than in all industrial investments combined. The wise young man or wage earner of today invests his money in real estate. That's a pretty cool quote. Here's one from Warren Buffett. I will tell you how to become rich. Close the doors, be fearful when others are greedy, be greedy when others are fearful. So that's what I've got for today, guys. That's a lot of information I went over, gave you a bunch of my opinion, but that's kind of my opinion and twist on things. Could we have a recession? If we do, it's just another buying opportunity because structurally, it's inflationary, demographic driven, and we have a shortage in the housing market. We need more homes to be built. The volume of loans are going to have to go higher. And if we have a recession, that just means that we're going to get lower interest rates. Lowering interest rates is good for the housing market. So the Federal Reserve is stuck. They are stuck because what they did is they blew up this entire market on low interest rates. Interest rates go up when we get an inflationary period. They're fighting inflation with higher interest rates, or inflation is dragging the interest rates up with it. Now, if we have a recession, we'll have to see what the housing market does. If we still have inflation, they're going to have to keep the interest rates high. But we have a market that's addicted to low interest rates. So they're in that predicament. They're going to have to start to handle an outcome. There's no solution. You lower interest rates, you're going to push the inflation button even higher. So stagflation is going to be a tough one for them to overcome because we've been addicted to low interest rates for such a long period of time, and a lot of companies around the world are addicted to low interest rates. It's going to be a very interesting period coming up. It's going to be very volatile, so get ready. I'm positioning for the structural changes in the markets where energy is a spot to be, in my opinion, structurally, because we've underinvested in energy. And under inflationary periods, liquidity seeks commodity-driven solutions. They seek commodities. Liquidity will go over there at the same time that we have a problem in energy. It's actually a very good setup if you're an energy investor and even a precious metals investor. All right, guys, that's what I've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website in the description link below if you want to join. A platinum membership will get you all access to everything in the companies that I'm investing in. All right, guys, thanks for listening. Catch you next time. This is Finding Value.